Members, and welcome to this meeting of the Governance and Audit Committee. My name is Councillor Justin Wrench and I will be chairing this meeting this evening. Before we proceed with the main business of tonight's meeting, I would like to start by welcoming Councillor Michael Staines to the meeting as the newest member of our committee. Big welcome to you, and thank you for being here this evening. Councillor Staines joins us though following the resignation of Councillor Tom Walsh, who has now unfortunately resigned in his capacity as District Councillor. On behalf of this committee, I would like to thank Councillor Walsh for his work on the committee and wish him all the very best for the future. I'll go through a few items of housekeeping. We're not expecting a fire alarm this evening, but should one sound, please can members use the exit to the rear of the chamber and assemble in the car park. And please can you make sure that your phones and devices are switched to silent. If members wish to speak during our debates this evening, please can you indicate by raising your hand and I will come to you at the appropriate time. This meeting is also being webcasted, so please can I remind you to switch your microphones on when you wish to speak and turn them off when you have finished speaking so that there isn't any interference. I will now proceed with the main business of tonight's meeting. And agenda item 1 is apologies for absence, and apologies for this meeting have been received from Councillor Andy Munday, Councillor Lynn Walters, Councillor Bob Wright and also Councillor Hayes. I don't believe there are any other apologies. Thank you. So I'll now proceed to agenda item 2, declarations of interest. So do members have any disclosable pecuniary interests, other pecuniary interests or non-pecuniary interests that they wish to declare this evening? And please state the item and the nature of your interest. Okay, thank you. There are no declarations, so I'll now proceed to item 3, which is minutes of the previous meeting. So please can I have a proposer to approve the minutes of an accurate record of the meeting of the Governance and Audit Committee, which was held on the 8th of October. Thank you, Councillor Ramage. And can I please seek a seconder? Thank you, Councillor Prime. So the minutes have been moved and seconded as an accurate record. All those in favour, please indicate by a show of hands. Thank you, members. The minutes are approved. I'll just sign those this evening. Very much. We'll now move to agenda item 4, public question time. Members, I can confirm that there are no registered speakers for this evening's meeting. So we'll now proceed to agenda item 5, which is a verbal update from KPMG on the progress of the audit of the 2024-25 accounts and reporting. Members, as explained for this item, we were due to have an update from KPMG. Unfortunately, they are not yet here at this evening's meeting. So I will now pass over to Phil Myers, our Head of Finance, who is happy to give a verbal update from his position from the Council. So over to you, Phil. Thank you.
Okay, thank you, Chair, and good evening, members, and hopefully not too late. Wish everybody a happy New Year. So as the Chair mentioned, KPMG were due to be coming for this item. So I can only think there's something unusual that's happened, or there's some reasonable explanation as to why they're not here. The reason it's a verbal update was the original plan that KPMG had presented previously was that they had hoped that they would have been reporting on the actual accounts, on the 24-25 accounts and their audit of those accounts at this meeting. And just to remind members, we're still working to the sort of backstop arrangements that government put in place in order to clear sort of the backlog of audits of accounts, and with a view to sort of trying to get everything back on track over the next few years. So that backstop date is the end of February. So this meeting was sort of lined up. We were expecting them to sort of bring their report. They are not in a position to do that, and that was part of the reason why they were going to give an update. And I think there are probably several reasons why that is the case, and I'm sure they will sort of address those points when they do report to this committee. We've got, as you know, an extra meeting has been set up for the 10th of February. And it'll be at that meeting that they will be presenting their formal report on both the accounts and also the value for money side. So I think it's fair to say the audit, I think it's been progressing pretty well. I think there has been some challenges on KPMG side in terms of resourcing. They've had some changes in their resources, and I suppose like any organisation that does create an interruption to the programme. So that has sort of meant things have perhaps delayed than perhaps we would have liked, and probably coincided with other work that obviously we have to deal with internally. So I think that's created some challenges for both offices here at Braintree and for the auditors. But I think we recognise that all organisations unfortunately face these risks around key personnel at key points of time. I think one of the things that they were going to report on, I think one of the areas. So at the moment, the process of the audit is to try and build back assurance on the council's position. To try and fill the gaps by the fact that several years of our accounts were disclaimed under the backstop arrangements, and particularly 2 years, essentially where BDO were doing the audits. There was effectively no real audit on those accounts. KPMG did last year's accounts, as you know, for the 23-24, and they're able to do some work around assurance, and then 24-25 was the sort of year when they were going to sort of build on that work they'd done in 23-24 and try and get as much assurance as possible, so that it put us in a good position for when they do the audit of 25-26 accounts. They were very clear that 24-25 accounts, irrespective of what assurance work they would conduct, we would get a disclaimed opinion for this year, and that would be really around the fact that they won't have done work on opening balances. So we were expecting that, and that was reported to this committee. That would be the expected outcome for 24-25, but they were also expecting to be able to give a large. We were expecting them to be able to give a large sort of view on assurance across the piece as part of that. So very much working towards getting things back on track. And then for 25-26, we were hoping we might then get something better than a disclaimed opinion, but it might still be caveated to a degree. One area they have had some issues on, and I think this might be reflective of the fact that because of audits not really happening over several years, it does mean that there's been a fair amount of scrutiny over areas that perhaps haven't had scrutiny for the last several years. So one area they have been sort of having some issues with is around asset valuations. So where we've got valuations on our sort of property assets, and some of the issues they've raised are around querying the approach that our valuers, so we appoint valuers to assist with those valuations, and KPMG then have their own in-house experts and to sort of do their sort of validation and verification checks and to see if the valuations look reasonable to them. So it's fair to say there are some difference of opinions between the two valuers, and I think at the moment we are still trying to resolve some of those issues at the moment. So there is sort of some ongoing dialogue between KPMG and our own valuers. But I think there will, but because of the backstop date, I think KPMG are not really able to do as much more work on that side, and therefore I think they will be referencing the fact that at this stage they're not able to obtain perhaps the level of assurance over the asset valuations that perhaps they might have anticipated they might have achieved when they were planning the audit. So I think we will, as I say, we will get a disclaimed opinion anyway. I think there'll be some quite a lot of positives in the report. I'm expecting from the last time I met with KPMG. I think there's a lot of work they have covered where they have made good progress. But I think it will be the asset valuations where I'm sure when they come at the next meeting, they'll probably want to explain thoroughly to the committee sort of their position on that. The value for on the value for money side, because they also report on the value for money side. Again, the work that they've done on that so far in the year has not revealed any issues there. So as of now, we are expecting them to give us, a positive opinion on the value for money arrangements of the authority. So I think that's where we are on the audit. And as I say, it's a bit unfortunate that for some reason Emma and Mark are not here to give that update directly to you. But that's certainly where I see the position, and I know Mark has been heavily involved in this side. So if there are any questions that members have got, then between us, I'm sure we can cover those off.
Thank you, Phil. Do members have any questions? Councillor Ball.
Yes. Overall, is the tendency for our valuations to be lower or higher than KPMG? It may vary.
Yeah, if you're able to come back on
Yeah,
that.
I think it's not so much about whether they're saying the assets are valued more or less. I think it's the approach. So, for example, I think they've questioned about. So our valuers have used certain information that's been gleaned from, I suppose, recognised entities such as Frank Knight. They publish information on things like property yields that are used in the valuation process. I think there's a question mark as to how that can be adapted and considered in a local context, and I think that's some of the dialogue that's going on to establish whether our valuers have taken into account, the local circumstances and conditions, rather than just relying on some data that could be deemed quite sort of high level. Now, the outcome of that could mean the valuations may be higher or lower than are stated. We do know that they've questioned on one or two assets again some of the recognition, and I think we're likely to head towards an adjustment to our accounts that will reduce the value of assets. So I think they're questioning why we're recognising certain assets at certain levels, and again I think we're in the process of agree what shouldn't be recognised and what that means. So I think that in that instance the valuations will probably come down from what they've been stated at.
So the reason I asked is obviously commercially and as a public body, the value of the assets and the returns affects decisions on whether we're doing the right thing by putting money into those assets or whether it would be better invested elsewhere. So.
Yeah, thank you.
So, yeah, I think on that, I think what I would say is we're talking about valuations here that are being used for reporting purposes, and local authorities, we do operate under a different sort of regime to sort of private sector in that sense. So to a degree, what we're talking about is something that is what I'd call just a paper entry through our accounts. It doesn't actually affect the bottom line resources that we've got. If, for example, we were looking to sell a property or dispose of an asset, then we go out and get separate red book, RICS valuations on those to test what that value should be, and then we also go through a process of seeking to get best value for those. So I think decisions around things like disposals and that are probably less impacted by these particular valuations, which are really around just trying to provide some reporting information in our accounts in that sense.
Thank you. Councillor Ramage.
Thank you, Chair. Happy New Year to you, Phil, and to everyone else. Yeah, there's a couple of things that kind of come to mind in this on item 335, where you were talking about expenditure. There's a.
We haven't got to that section yet.
Oh, haven't we?
No, that's a separate report.
I'm mixed up then.
Okay, fine.
Did you want to hold those questions?
Yeah, I'll hold those, please, Chair. Sorry, I got
Perfect.
slightly mixed up.
Thank you. No problem. Councillor Van Dolken.
Thank you. Phil, a question and a comment. I'll take the comment first. It strikes me that the value, and I know nothing about this world, but the valuations are being done in such a way that they don't take account of local conditions sounds to me very strange, quite frankly. I mean, we're not in Mayfair, neither are we in a slum district somewhere. We're somewhere between, I guess. That's just a comment, and maybe you could give us some view on whether that is normal in this kind of circumstances, that kind of valuation is done. And secondly, just the question is, how often is this done every year, the valuations?
Yeah, thank you, Phil.
Yeah.
KPMG on their way. We'll give an update at the end.
Okay. So so I think that is one of the issues that is sort of ongoing between our valuer and KPMG. So I think KPMG, on the face of it, think that there hasn't been a reflection of local circumstances. I think the responses from our valuers are that they believe they have taken that into account. So I think there is a case of just one valuer trying to convince another valuer what they've done and satisfy them on that. So, and that's why I say that's ongoing. In terms of the valuations, yeah, they're generally done annually anyway. So, yeah.
Thank you.
Yeah. So I was just going to say, Chair, I believe I've just got a message that KPMG are going to be attending at some point this evening. Yeah. So it's obviously your
Yeah, that's fine. I'm
discretion
sure
to
if they arrive in time, we can
accommodate them how you see fit.
see if they have anything to add that you haven't already covered. But no, thank you for confirming that. So if there are no further questions, sorry, Councillor Heath.
I was just going to ask you. You have more or less answered everything. That's it. Asset valuation is, in this instance, mainly for the books and for us to look and trade upon, because the value of any asset is only truly known when you try to dispose of it or try to rent it out. Because so I know the assets of the business that I work for were never worth what the company put down on the paper that they were worth, but that's what they borrowed against. So and as you say, that a public body is not allowed to just dream up its own value, is it?
No, and you're right. So, as you say, when we come to dispose of an asset, we would take a specific red book what's called the Red Book RICS valuation then to test the best value of any proposals. Yeah, what I was just going to add is and as hopefully if they do able to update, the situation they're sort of flagging here is not unique to Braintree. So that's what, you know, they've said they're finding. So it may well be because KPMG have come into the local audit market on this most recent contract in process. So prior to this, they were not in this space of doing the sort of local audits for councils. So you know, whether that's a factor, you know, they have their own house, you know, rules and requirements that they want to meet as a firm. But that is one thing that Emma did say, you know, the issues they're finding here from their perspective are not unique to Braintree. They found that in other places. But it does mean that, you know, going forward, we do need to find a position where, you know, we can get valuations that they're going to be satisfied with, because ultimately they've got to sign off their report. We can't, you know, we can't make them sign their report. They'll only do it when they're satisfied. So we just need to work with them to get to a satisfactory position where everybody's happy that the valuations provide a fair representation. And as you say, you won't ever know the true value unless you were trying to sell it. So this is always going to be, there's an element of subjectivity here, and so, yeah.
Okay, thank you. So we will now proceed to agenda item 6, which is the key financial indicators and second quarter financial review for 2025 and 26. I will now introduce this report that is set out on pages 5 to 12 of tonight's agenda, and I will re-invite Phil, who is our Head of Finance, to present tonight's report. Over to you, Phil. Thank you.
So yes, as the Chair's mentioned, so this is this picks up on the second quarter financial review and provides our latest forecast on the budget position for the current financial year. And then, as committee members know, we also track a number of indicators as well on some of the council's sort of financial areas and activities. So picking up on the second quarter financial review first, we are reporting, or we were reporting at that stage, a positive variance for the year of £1.5 million. I think that was a slight sort of change from the first quarter. If I recall, the first quarter was 1.3 million. So the shift in terms of the variance is around 200,000 in a sort of positive sense. Where that is being made up, so staffing expenditure you can see is forecast to be under budget by £478,000, which is you know, around just shy of 2% of against budget, and that's mainly really from vacancies that have been held in several service areas, particularly sustainable development, sort of planning and landscape, but also in operations and governance. That said, there are some areas where the situation is not as positive, and I think we've reported on this previously, particularly in terms of environment, building control, where there's a very tight market there in terms of expertise. Government have changed the requirements and rules for building control inspectors that work in this sector, so that has made it quite difficult to attract staff into that area, whilst at the same time we've got growing statutory requirements to meet and fulfil. So that has left us in a situation where we are at the moment still reliant on interim staff, which as you would expect in that type of market will command you know, a higher fee than perhaps we would pay if we were appointing somebody on our own terms and conditions. So that is still an area that we are still working on trying to address. In terms of other expenditure, so this is everything bar staffing. We're actually showing that we've got a slight over sort of budget in terms of forecast, so £306,000, which is sort of around 0.7% of the actual budget. And I think the areas where we're seeing most of that pressure come through is in sort of demand, what I would call the demand-led areas, so housing service. We're seeing pressures there around use of temporary accommodation, and that's has got a consequential cost implication for us. And also in our operations, where we are seeing variances in terms of some of the activity that's goes on in that area, particularly around sort of changes in tonnages of materials, and we are seeing contract pricing as well hardening at the moment. In terms of income, this is where really, I suppose, this is the main driver of the positive variance. So we are projecting an overachievement of income of 1.3 million. 841,000 of that is from our treasury management activities. So this is where we are investing sort of money that we're holding in our sort of balances and reserves, and through cash flow, through our sort of normal cash flow, and generating interest and dividends. But we are also got some higher income in some of the other areas, such as car parking and garden waste, and planning, which I think has been pretty consistent with what we were reporting at the last quarter. Again, we've got some areas where income is less than the budget. So the Plaza, particularly around the makerspace and casual lettings, and Victoria Square, and I think we sort of recognise, particularly the Plaza one, we've recognised the challenge with that makerspace, and so I think there has been some repurposing of some of the space, but also we are adjusting for that through the sort of upcoming budget to sort of reset the target going forward. So we sort of set a more realistic budget for that. So that quarter, so that was reported to Cabinet on the 15th of December, and so there's a much more detailed commentary that goes with that. At this stage, as I say, we are in the thick of the budget planning for 26-27, so I think it's fair to say that a fair amount of that in-year variance we are picking up into our 26-27 budget. So members will have probably seen that when we had the corporate scrutiny committee session on the budget and highlighting where we were making changes. Quite a lot of that was a result of some of these in-year variations that we're reporting on. In terms of the capital programme, at the first half year, extra expenditure was 2.6 million, and that was against a profile programme of 13.6. So still a fair amount potentially to spend, and you can see in the comments there that we're actually expecting a fair amount of spend in the fourth quarter of this financial year. Much of that is linked to the investment that we're making into the waste collection changes. So as you'll know, there's a fair amount of capital one-off investment that were required in order to get that up and running from next year. Again, there's an underspend forecast of 861,000. Again, we reported on this similar the last quarter, and that's mainly around the Causeway House refresh project, where I think with local government reorganisation, on the horizon. I think we've taken the view to sort of scale back some of that investment that we'd originally planned in Causeway House, and we're now just doing works where we think that will have an immediate impact on the working arrangements without sort of spending the 1.2 million we'd originally planned. On capital receipts, so at the end of the quarter, we sort of generated £2 million of capital receipts. Much of that has come really through the right to buy arrangements we have with Eastlight, which again members might recall, we had a period when essentially receipts through that route dried up and we were receiving nothing because of the conditions in the housing market and just the general economic outlook. So I suppose it's pleasing to see some of that coming back in now, and that does give us some resourcing for our capital programme. In terms of the key financial indicators, so those are set out in sort of the Appendix B. I think things are just flagged really. Council tax collection, yes, it looks like we're down from where we were at this point last year. We're not out of line with what seems to be the case across Essex, and actually our performance when you compare us with our neighbours, we were sort of one if not the highest collection at that point. But we do know, I mean, the collection rate can sort of vary month on month, so obviously we do keep that under review, and we'll see, you know, how things change over the rest of the year. But then conversely, business rates, the collection rate is actually higher than last year, but again, I think the same thing applies. It can vary month on month, so we will sort of again continue to monitor that. There's information about write-offs, and I think it's fair to say we're doing a bit more work around write-offs at the moment. I think again having an eye to the future about our aged debt, and making sure that what we've still holding on our books we really do think is collectible. So that is leading to a bit more activity around write-offs. We do know also that there's, and I think some of this comes through media and people on TV sort of encouraging people to go down different routes, and so we are seeing debt relief orders and individual voluntary arrangements still being a main reason for write-offs. As I've said previously, particularly with the involuntary arrangements, while we do write off the debt, that is subject to a sort of a payment then plan, and we do monitor that, and see if that's defaulted, then we can sort of restate the debt and then resume recovery action. But I think even at this level, I'm happy that, you know, it's within the sort of provisions and expected norms that we allow for when we set the budget in terms of potential write-offs. On sundry debts, again, 2.7 million outstanding. About a third of that was still at sort of invoice stage, so, you know, regard that as not problematic debt. And again, housing benefit overpayments, we know that's quite a sort of sticky level of debt that we carry. It's quite restrictive in terms of what we can enforce people to pay against those arrangements, but nevertheless, we do sort of continue to collect from that income from that source. Supplier payments on target, and lettable units. Again, occupancy probably a little bit down from what we reported at the last committee, but still probably fairly good at 86%. There is apparently still quite a bit of interest in our properties. I think it's been recognised that some of our properties are needing some investment, and I think where we've got occupancy voids, we are taking opportunity to do works on those properties and bring the energy rating requirements up to improve those, so making them more attractive to let out in the future. So nothing that I think our asset manager is overly concerned there with. And then in terms of investments, you can see there the levels of money we've been managing and the interest that has been generated from that. So a fair return on our short-term investments, and then we continue to see sort of good dividend payouts on our pooled funds, the £19 million, and particularly so the sort of value of those funds. So we've got £19 million invested, but actually market value at the end of November they were worth 24.3 million. But I suppose going back to the conversation we had about the property assets, you know, nothing's ever worth what it is until you actually come to sell it. So, you know, until you sell those funds, you don't know exactly what you would get back. But on the 30th of November, we would have got back a lot more money than we've actually put into those funds, which is obviously very a good position to be in. So happy to take any questions, Chair, on that.
No, thank you very much, Phil. As always, a very detailed report, so appreciate that this evening. Members, I know Councillor Ramage is keen to ask a few questions. Does anybody else have any questions? Thank you. We'll start with you, Councillor Ramage. Thank you.
Thank you, Chair, and I'm sorry for the mix-up earlier on. Had a hard day. Phil, going back to item 334 regarding staffing, etc., where you're talking about a figure of 478. Is there an issue regarding staffing as far as the council is concerned? And you know, I mean, in particular in planning environmental, it seems to be an area. Is it a case you are losing staff, or is it you are finding it difficult to recruit staff to those areas as such?
So I think it's a combination. I think there is a churn in staff, but I think also it's particularly about getting people into posts that we've sort of created. I know, you know, particularly in planning, the important, if you remember several years ago, we put the council voted through in the budget to put a lot more money into things like enforcement, and so they got the money, but it's just trying to get the team in place. I know, you know, it's one area where they've struggled to get a full complement in place. Landscape services as well, I think, seems to be an area that they've struggled with trying to fill where people have left there, and again, that, if you recall, that was sort of flagged through our strategic risk process. You know, some of the issues around landscape services. So again, some more money was sort of put into that area, but it's all right giving the money, but it is trying to get the staff. As we said, environment is an area where they're having difficulty, but because of the statutory requirements, we're having to sort of fill that through what is more expensive stuffing. So I think one of the things that KPMG, I'm sure when they come to report on the value for money, I think they do touch on sort of the staffing position, and I think they are aware that, you know, there are councils that are really struggling on retaining staff, and I think they've, you know, looked at our position, and I think it's good. Whilst they recognise we have got some pockets where there are difficulties, I don't think at this stage it's seen as a problem for us.
Could also one of the issues be due to local government reorganisation, that people are looking at it as a long-term thing that is not going to occur, because, you know, we don't know where staff are going to be or whatever, you know. So they're kind of looking elsewhere in a different area of the job market. So, I mean, obviously there's a lot of competition, as I've known, with planning over the years. The thing is that affecting the actual process of planning? Because there's normally on applications it's 12 weeks to get an application presented. And I'm just wondering, is that having an adverse effect in that particular area?
I don't believe so. And if I recall, so the stats get reported to as part of the quarterly. So as part of the finance, you get the quarterly, all the KPIs and that of the authority and that. I don't recall offhand that the planning ones are, flagging anything problematic in that sense. LGR, whether that's having an effect of people. I'm sure there's lots of reasons, but I think we're not unique. We know that our neighbouring authorities struggle in certain areas and that. So
I've got another question, but I'm willing to.
No, it's fine.
You sure?
Yeah, please continue. That's absolutely fine.
In relation to write-offs, we're talking about quite a chunk of money here, 446,000. How has that occurred as such? Because that seems quite excessive. I mean, what's the tolerance as far as the council is concerned on those sort of numbers?
So as I said, I mean, it does sound like a lot of money, but then when you think we're collecting sort of £100 million of council tax and sort of 40 million of business rates, and these write-offs are not all about 1 year; they're about prior years as well. So if you actually express these as a percentage of what we're actually collecting, I think you'll find it's quite a very small percentage. It's certainly within the parameters of what we provide. So when we're making assumptions for the budget, we do make sort of assumptions about what we think non-collection might be in those areas, and this is well within those parameters. But as I said, I think a lot of the write-offs are where we've effectively exhausted all means of recovery, and that's even going through, using enforcement agents, attachment of earnings, attachment of benefits and the like. So we only write off when we really feel we've exhausted all possible routes. But certainly, with businesses, if businesses go into liquidation and the like, then, we have no, that's an economic impact, and that we have to just recognise that, I'm sure we all know sort of businesses that have gone into that stage in the district, and if they owe us business rates, there's not really a lot we can do. I mean, we do register in those instances with the administrators, so if there is any chance of getting some money back at a later date, then we are sort of registered as a debtor. But at this stage, we would take the prudent course of just of writing that debt off. And the same with individuals. Whilst we might write off debt because we feel we've exhausted, if at a later point suddenly some information comes to light and we're able to think, well, actually there may be a chance now of getting some debt out of that, we will then recommence sort of recovery action against somebody and try and get some money. So I mean, the write-off is just a recognition that I think at this point in time we've exhausted what we can, and it's imprudent just to carry it as a debt that we still feel we're able to collect.
You said it's not just 1 year. How comes? I mean, you kind of think this relates to a particular year, but are you saying it dates back over a period of time?
Yeah. So the arrears we're writing off here might be debt that was outstanding.
Are you carrying that forward every year in effect?
Yeah, well, whilst we consider it to be collectible, we would carry that on our balance sheet as collectible debt. But what we do is we have a provision on our balance sheet as well of how much of that we think we won't collect. So we're not, in that sense, again, we have to sort of satisfy our auditors that we're not overstating the amount of debt, amount of income we expect that we will recover from that. They would expect us to make some allowance for non-collection. So, yeah.
Okay, thank you very much indeed. Thanks, Chair.
Okay, thank you. Councillor Prime.
Thank you, Chair. Thanks, Phil, for your report. I must be learning now because I've got a load of questions for this. And I blame you for teaching me lots of things. Following on from the debt, that Councillor Ramage, what's the sort of timescale do you look at? Do you sort of give these people 5, 10, 15, 20 years to pay this sort of debt back? Is there a timescale for it?
No, I mean, there's no set timescale. I think we review every case based on the information we have. Like I said, I think in some cases, if we've got an involuntary arrangement, and these are, you know, arrangements where essentially we can't not write the debt off, but they do enter into arrangement where they will make some payments, and so that when that money comes in, we effectively restate the amount of debt in recognition of what they're paying back. But things like debt recovery orders as well, you know, if we get a debt recovery order, somebody's gone through that process, we have no option, and that might be, you know, that might be on some debt that's only, you know, quite current, but it might be on debt that is, you know, several years old. If it's a business that's gone, you know, into liquidation or something, you know, that might be, again, current debt, it might be debt over several years. So there's no hard and fast rule to say, well, once debt has got to this point, we will write it off. We do use that when we're making provision, so we tend to make a higher provision on all debt that's 3 years or more over, because we feel there's a high risk there. But that doesn't, just because we're making a high provision against it, doesn't mean at that point we're making the decision to write it off. Each case would be looked at on its merits and you know what information we've got. You know, if we can't trace a debtor, and if we've gone to the enforcement agents and they've really considered.
Right, thank you. That was the last one. Going back a little bit, on 3.4, I'm going to jump about a little bit. Staffing levels, you state that you're using interim staff to cover vacancies. What sort of, how many
Of their staff. So, yeah.
Thank you. And do you put a sort of figure in the budget to cover this sort of expenditure?
So where, like I said, so where we use it, I suppose almost part of having that sort of flexing capacity in our operations. Yes, certainly we have they do have specific budgets for their agency spend. In areas such as Environment Act, what we would do there is, because these are covering substantive posts, the budget for the substantive posts would be there anyway. So, you know, there would be a large element of funding there. What you'll see is we are putting into the 26-27 budget, I think one of the pressures we identified was the environment building control function. So recognising that that's an area that has had difficulty for quite a period now, we are recognising that by putting some extra money into the budget for that. But, you know, in other areas we would probably just take it as a sort of an in-year adjustment rather than necessarily pre-planning the use of agency, but on the basis they've got the budget for the substantive post anyway. So, yeah.
Still got a couple to go, Chair.
That's fine.
If you don't mind.
Yeah,
sorry,
please
Phil.
continue.
3.35 in operations, the processing costs for recycling materials, etc. Are these fluctuating costs? And the second part of that, with the new regulations coming in for waste collection in June next year for us, are we looking for these costs to rise?
So again, yes, they are sort of variable costs in that sense. So quite a bit of so if you think about it, the volume of material we're collecting, the types of material determines, you know, what the haulage cost will be. There'll be gate fees that are paid at the processing centres for that material. So they are variable in the sense that, you know, they are sort of linked to the tonnage collected. So as that tonnage may vary, then, you know, those costs will vary. In terms of things like contract pricing, again, we know, you know, several, you know, we tend to put in contracts for a period of time, and when those contracts come up for renewal, it's not unsurprising that we find that in the contract pricing that we're being offered at that time is higher than we've been paying. So again, you know, we try and pick these things up as part of our budget. So you'll see again in the budget for 26-27, we are putting extra money in for, you know, those procurement risks where we've had to go out and re-procure and recontract, and it's now costing us more. But yeah, I mean, there is a high degree of variability in there. But on the contrary, and that's where, you know, things like on the because you in the 3.36 we reference their, you know, additional income, and we've got their income from recycled materials. So whilst we're paying more for haulage, we're paying more on gate fees, we are also getting more income from that material so as well. So some of it is sort of offsets and is related. Yep.
And my last one, thank you for indulging me. Appendix A, and your nice little charts there. Sustainable development. After operations, it's quite high. So what are your sustainable developments? That is only in operation business plan and, of course, in staffing costs.
So sustainable development includes our planning department and landscape services. So as we've said, landscape services and planning is one area where they've had you know, levels of vacancy, so that they've been sort of driving quite a bit of the staffing underspend. You can see there in the table 382,000, and also you can see also driving some of the income variance. So we know after the budget was set, the government did increase household application fees by quite significant percentages. So that hadn't been captured when we set the budget. So some of that uplifting income is sort of just recognising that the pricing that they're charging for applications is high. But then also there is a you know, applications can again fluctuate, particularly things like the major applications, and you only need one or two of those more than you anticipated, and your income could be a lot more. So so that's what's in sustainable development. That's what's really driving those variances. It's the vacancies in planning and landscape, but it's then the additional income that planning has been generating.
Thank you very much. And thank you for indulging my questions. Thank you, Chair.
No, thank you. Next I have Councillor Staines.
Thank you, Chair. Just picking up on Councillor Prime's point about the recycling costs, I guess, and is it fair to say, is the question, that BDC's processing costs may rise whilst Essex County Council's costs for landfill reduce as they send it somewhere else. Is that a fair comment?
So yeah, so so if we recycle more, there are costs to us from treating, you know, managing them, that waste in terms of taking it to a processing plant, and they charge a gate fee. But then, say, depending on the quality of that material, we also do get an income from that because that material is then sort of sold on the market. There is a recognition between the relationship between ourselves and Essex County Council through the Waste Inter-Authority Agreement. So they do pay as something what's called recycling credits, and that recycling credit payment is partly to recognise the fact that they are making savings on landfill costs. So that was part of that inter-authority agreement about trying to encourage the districts as collection agents to try and collect as much recycling material as possible and avoid it going to landfill. So there is a sort of financial mechanism in that agreement that sort of recognises that.
I'll add one more, if that's all right.
Thank you.
I guess this is more of a question for KPMG really, but the run rate of housing benefit costs, which is going up, as you highlighted in your report, versus the receipts from the right to buy. I appreciate one is a capital lump sum, another is an ongoing revenue sum. Will they make an assessment on whether that represents value for money, or just comment on that in general?
So yeah, To be fair, that's slightly conflating two different issues. So, as you say, the right to buy receipts, so that's where Eastlight sell properties under the right to buy of people who transferred when we transferred the housing stock. So we've got that. We've got sort of an arrangement there where basically the lion's share of that still comes back to the authority. That is time limited, and that will end, and that will stop. But I think the properties that they're selling under right to buy are probably not, I would say, probably not necessarily the properties that we would be wanting to use for the temporary accommodation pressures anyway. So I don't think you could correlate the right to buy sales with a consequential increase in our temporary accommodation demand. I think it's, yeah, the demands on temporary accommodation probably quite, as you would imagine, quite numerous, aren't they? Reasons why people become, you know, homeless, or, you know, or risk of homelessness and the like. So yeah, I wouldn't draw a correlation there necessarily between those two factors in that sense.
Okay, Councillor Heath.
Thank you, Mr. Chairman. Could I just ask Phil, on the right to buy receipts, still, am I correct in assuming they're only on any property that was transferred from the district council to the housing association, not any that they've acquired after the? If they sell a house that they built, for the want of it, that is their receipts, not ours at all. Is that correct? Right, thank you. Yeah.
Thank you. And Councillor Ramage.
You mentioned agency staff just now. Interesting enough, I had a refuse cart come around my home last week, and I just happened to speak to one of the guys, and he said he's been an agency staff member for 6 years. Is that quite common with all the refuse people? I mean, because it seems, you know, I mean, I kind of think, why can't he be a permanent staff member instead, you know, and cut the cost down?
Is there anything you can add?
Yeah, I mean, yeah, obviously it's not my area of expertise, but I mean, I think the agency, as I said, I think the agency pool is used to flex the resources we've got. So, but, you know, I think ideally, as the authority, would want to use agency staff that we've used previously because they'd have knowledge of the routes and the like, and we would know them. So I guess that probably does help why somebody could be an agency working for us that long as opposed to being permanent. I
Okay,
can't comment.
Sorry, it was just as it was mentioned, I thought it suddenly brought me. But my other question I would like to ask, if that's okay, is related to, where are we? Sundry debts, the housing benefit overpayments of 1.4 million. How has that been occurred, and does that relate to one particular year, or is it another one that's been run over from other years? Because it seems an excessive amount of money.
So no, that's an accumulation of over a lot of years. That 1.4 million. So housing benefit overpayments, and these are ones where, because we can recover these, because these overpayments arose because of claimant error or fraud. So if somebody has, you know, provided misinformation to us and that's meant we've overpaid them, we would reverse, obviously, that benefit that they've received, and then, you know, we would then seek to recoup that from them. But that debt is, as I said earlier, is quite sticky, because essentially you are trying to then collect debt from people who, you know, we're interacting with them basically on the basis that, you know, in many cases there will be cases where, you know, they're still sort of in, you know, they're not, they're sort of low income households and the like, or there are restrictions over how much we can take from them at any one point. So if we're doing like an attachment of benefits or the likes from them, we are restricted on how much we can do that. So that will be an accumulation over many years.
So would you make some sort of arrangement where they pay so much a month back and that sort of thing, so it doesn't hit them too hard?
Yeah. So there are some there that are paying, and yeah, say they're done on an individual basis, and the amounts that individuals are assessed to be able to pay can vary. So some of that can be people who are paying over a long time very small amounts of money, but we are restricted on what we can push for in that sense.
Okay, thank you all. We are asked to note the report of the key financial indicators for the financial period ending the 30th of November 2025 and the second quarter financial review and forecast budget outturn for 25-26. So please can I take it that the report has been noted by show of hands? Thank you, members. The report has been noted. So we'll now proceed to agenda item 7, our internal audit update. So this report has been set out on pages 13 to 26 of the agenda. And please can I invite Angie Mitchell, our Audit, Insurance and Fraud Manager, to set out the report.
Thank you, Chair, and good evening, members. So this is the regular report to this committee. It details the progress against the current year's internal audit plan and gives a summary of the progress and the outcomes of audits completed since the last report to this committee. So paragraph 3.3.2 at the top of page 14 lists 5 audits completed since the October report to this committee. The last one in that list is a limited assurance report, and the detail of the recommendations, the outcome of that audit, is on page 22 and into 23. So all the recommendations made in that report were agreed and have been assigned with action dates to resolve the issues raised, all within an appropriate timescale. And the dates for completion were all around November and January. So we've not yet had the opportunity to follow up on those recommendations to see the current progress, but it's highly likely that they will be complete or substantially complete by now. So, Chair, I'm happy to take any questions.
Thank you very much, Angie. Do any members wish to speak on this item? Councillor Van Dolken.
Thank you, Angie. As you pointed out, the plaza is the only one with limited assurance. I had a look through it. It doesn't look to me anything terribly serious. I'm serious in terms of prejudicing the authority. Could you just say a few words about it?
Certainly, yeah. So a number of the recommendations were relating to records. So the first one there was around maintaining a list of inspections, risk assessments and planned preventative maintenance. The second was around a compendium of information on daily checks and general maintenance. The third was around records demonstrating completion of proposed recommendations and remedial works. So they're all around record keeping, and I know the team has been doing a lot recently, has had some restructuring, has been working a lot on building this side of it up. And then the last point was around reporting to the Property Asset Management Strategy Board and Management Board, so keeping those informed.
So it mentions the change in management. Is it Jeremy? I can't remember. Is he leaving, or the gentleman who?
So obviously he reports to Edwina Crowley, and she has obviously been working with Jeremy to implement these things, but a lot of the record aspects of it are with the Property and Asset Management team.
Thank you. Next I have Councillor Jeffress.
Thank you, Angie. It probably isn't a question for you to answer really, but I was just intrigued on page 35. One of the ongoing reviews was on the CCTV and the revised policy relating to body-worn videos. I just wondered who actually wears body-worn videos. Is that some of our recovery staff or anything like that that wears them? Do you know?
So this policy is really driven by the street scene team.
Right, yeah.
So they conduct enforcement, various aspects. So it's primarily them.
I'll ask them.
Thank you. Do any members wish to speak on this item? Okay, if there are no more questions, we're asked to note the progress against the 2025-26 internal audit plan. So please can I take it that this report has been noted? Thank you, members. The report has been noted, so we'll now proceed to agenda item 8, our fraud update. But before we do, I can recognise that we have had Mark Twyford enter the room. So what we'll do, Mark, is we'll continue with the agenda, and I'll bring you in after agenda item 10, and then we'll have an opportunity to hear from you, if that's okay with you.
Apologies for being late. I think it hadn't entered our diary, so...
Okay, no, I appreciate you making some last-minute adjustments to be here.
Not a problem at all.
No, thank you. The fraud update is set out on pages 27 to 46 of tonight's agenda, and I'd like to re-invite Angie, who will be setting out this report this evening. Thank you, Angie.
Thank you, Chair. Okay, so the report starts with a few wider statistics on fraud. I draw your attention in particular to paragraph 1.3, the National Crime Agency National Strategic Assessment for 2025 reported that fraud now represents 41% of all criminal activity. So that's quite a high figure. The CFAS Fraudscape has identified a few particular areas of fraud. So identity fraud is quite significant, and you'll notice from the previous report, the internal audit update, that we have an ID verification audit in the current year's plan, and the work on that has now been allocated, so that's just about to commence. Misuse of facility is also quite high, and account takeover. So the report goes on to give some outline of the CFAS Fighting Fraud and Corruption Locally strategy, the pillars and themes that drive that. And in terms of the national context, there's also some narrative on the National Fraud Initiative and some legislation which was brought in 2023 on the Economic Crime and Corporate Transparency Act, and the offence of the failure to prevent fraud was effective from last September. So fraud resilience is a whole council approach. It's something that everybody here needs to be aware of. We need to understand our fraud risks and adopt appropriate, proportionate methods to identify and address, mitigate those risks. So part of that is that training is a key element, and in paragraph 3.10.1 we refer to some of the training that has been applied, and that includes some general learning which references some enhancements to the council's e-learning system, which addresses some fraud related topics in new learning that's been brought in. Paragraph 3.2 details some typical frauds affecting public sector, and then paragraph 3.3 goes into details of some of the arrangements that Braintree District Council has in place to identify and mitigate fraud risks. So that goes through to paragraph 3.4 as well, with the fraud investigation, and 3.5 with the data matching and analysis. On that data matching reference, just above paragraph 3.5, it references the single person discount matching, So we're currently considering an option to extend some single person discount matching. We're just in the process of considering the relative cost versus benefit potential of that. So 3.6 goes on to the corporate enforcement group. So again, this is more activity within the council to address it. 3.7 refers to the checks made in respect of grant applications, and then 3.8 to a number of corporate policies and procedures. 3.9 is the gifts, hospitality and interests part, and we're currently reviewing the policy relating to that. So that's in progress at the moment. Again, I refer back to the previous report on the internal audit plan progress. We had an audit in that around it's number 21 in the plan, declarations of interest compliance. So we're actually looking at reviewing the policy approach that we have, enhancing the declaration protocols, and so the audit on that is likely to be deferred until we've got some new arrangements in place and embedded them. Chair, I'm happy to take any questions.
Okay, thank you very much, Angie. Do any members wish to speak on this item? Councillor Ball.
Thank you, Chair. At the top of page 29, under clause 3.1.2, mentions fraud by staff, insider threats. Bearing in mind what was said earlier, that in some specific areas we employ people through agencies, is that a greater risk or at all?
Not necessarily, no. The resilience to have people in place to conduct the checks and the controls that we need to mitigate the risks is a good thing. So the fact that we're getting people in from outside the council isn't itself a negative.
Thank you.
Thank you. Councillor Burbage.
Hi, Angie. Couple of things. With regards to one particular area of fraud, I think is quite an ongoing, expanding thing, is online fraud. And do you find that that is an issue that you've come across where you've found cases of that happening to the council? And the other question is, you make reference to training staff. You highlight on here 11 staff trained, but are they particular areas of the council where you have trained these people, or is it a thing that's open to all the staff?
Thank you, Councillor Ramage. So in terms of online fraud, yes, we're very aware of the changing methods adopted by fraudsters, bad actors, to get money. And so online methods are increasing. The use of AI is increasing. So what can I say? So there will be elements of that target the council, and there will be elements of that target residents within the district as well. In terms of threats to the council, we've got various means of checking and identifying, and we're also part of a network that shares information on frauds that are committed against councils. So we circulate information on new issues to the relevant services, and we share that with them. In the same way, the training, the modules on the council's e-learning system are available to anybody, any member of staff to go through. Some of the training is service specific. Some of it is down to services understanding the risks relevant to their service areas and identifying what they need to do to address those risks. So some of them may be particularly targeted to an area of operation.
If there's a particular issue that comes up, you can flag it to all staff members that to look out for it going forward as such. Yeah.
So when we receive fraud alerts for issues happening in other bodies, other authorities, then yes, we circulate those to the relevant staff. And if we identify a particular weakness or issue, then we're approaching the people responsible for that area to resolve.
You liaise with other councils then on that sort of thing as well, do you?
So the fraud alerts are compiled with information from yes, other councils. So there's an approach to sharing information internally to be aware of the risks, the things that are happening, and so that we know that we need to look out for something and to address it.
So some of the stuff that you, just one more thing, some of the stuff that you get false, like false invoices, that sort of thing, does that come into it?
That's one potential area. Procurement fraud is one issue. Yeah.
Thank you very much.
Okay, thank you. Councillor Van Dolkum.
Yeah, thank you, Chairman. Angie, just looking at page 34, where you give some figures, and for the various years, are these all fraud, or are they potential fraud? I mean, generally speaking, just so I can get an idea of the amounts involved per year.
Okay, so the new cases, the files opened, they are all potential for fraud. So there's been a reason that they've been flagged for investigation, but not all of these will turn out to be fraud. So probably the majority of them will be cases where no further action is required. But then the amounts, the housing benefit overpayments, council tax support overpayments, and so on, they are all actual frauds that have been identified and costed, if you like. So these are the amounts that are being recovered, as Phil was talking about earlier.
Right, I can just follow on.
That's fine.
And in your experience, how do we rank in these terms compared to neighbouring or similar authorities?
I don't have figures. We're all different in terms of the makeup of the district and the number of cases, and some have more investigation capacity, some have less. So I don't have figures. The comparisons tend to be made on fraud skills, so the number of investigators, the resources allocated to the fraud activity.
Okay, Councillor Jeffress.
Thank you. I was just going to say about the training. Last year we had some excellent member training for fraud and the ways that we can solve it. Quite scary, to be honest. But if anybody wasn't able to be at that training, it certainly were. I'm sure it's online, and certainly, as you say, there's a lot of training online. It is really worth members having a look at the training as well, and the things that we can do to prevent some of those things happening and coming through on the council. That wasn't really a question.
No, but thank you. And I have Councillor Heath next. Thank you.
Yeah, thank you. Mine actually is on training as well. It's fine for everybody that is office based or desk based or whatever. But how do we ensure that we get the message out to those members of staff that aren't in an office or haven't got direct access to something like this? I'm thinking of the gardeners, the refuse collectors, especially the 6-year agency refuse collectors that go around Ron's and things like that, because these are the people that are obviously going to be the weak link in any chain, those that aren't being sent in the right direction, or are we ensuring that from above that part of the chain doesn't get hit?
Thank you. So in terms of non-office based staff, remember it's the whole fraud resilience is a whole council approach. So the operations service will need to be understanding the fraud risks relevant to their areas of work and adopting the right protocols for sharing that. And it could well be the culture, it could be the checks and balances that they make, it could be their response if anything is identified, and the wider knowledge of that. So there's a number of things that they will need to do to ensure that their service is protected from fraud risks.
Yeah, I haven't. I've been trying to word it better in my own head, because the thing is, these when you hit these type of people, they're going to be very low level fraud. You would imagine,
Yeah.
but lots of low level fraud becomes a medium level, doesn't it? Once it's spread over the whole business.
You're right.
I'll have a bit of think about it
Well,
and come back to
you're
you.
right.
I think.
It's balancing the opportunity that they have for it, and so there isn't a lot of like, cash collection or anything like that. The service will be aware of what they need to do to protect their assets, for example, stocks and stores and things like that. So they'll need.
That's it. It's like getting an extra bin out somewhere that's saving somebody £5 a week, and
it's a different type of fraud.
Yeah.
But in terms of the monetary value, I would think the bulk of it is still the online type of fraud.
Okay, thank you. So if there are no more questions, members, we are asked to note this report regarding the fraud update. So please can I take it that this report has been noted? Thank you ever so much. So this report has been noted, and we will now proceed to agenda item 9, which is the Strategic Risk Register. This report is set out on pages 47 to 78 of tonight's agenda, and I'll be inviting Phil Myers to set out this report. Over to you, Phil.
Yeah, so as members may recall, we did have a session earlier in the year with, as part of the member development evening on the 8th of September, where all members were invited to consider the Strategic Risk Register and have the opportunity to receive a presentation on each one by the what was called the risk owners, so the relevant cabinet portfolio holders, and to have the opportunity to question those members and senior officers on the particular risks that were identified at that time. So this report is really just part of the sort of formalisation of that review process. So the Strategic Risk Register, following on from that, was agreed by the Cabinet at its meeting in November, and this is just like the follow-on to give this committee now an opportunity to have any sort of further comment or to make any further observations on the strategic risks. There will be another review process that will be kicked off in the not distant future. So as we try and keep this under review as regularly as possible. I think in terms of this one, there was not a huge amount of change in terms of scoring, and as the report sets out, we sort of look at risks in two ways. One, in sort of their sort of inherent state, so what is the risk and what does that score, and then we take into account some of the controls and mitigations that we've got in place to come to sort of a residual score. And 10 of the 12 risks remained above the risk tolerance line, and those are the ones that we put sort of most of the effort into sort of managing and monitoring and making sure that we're dealing with the controls, there was only one risk that actually changed the score, and that was the medium-term financial strategy and financial resilience one, risk one. So the sort of score there increased, and that was really around the government. We were, at the time, we were getting a strong signal that government were going to undertake and implement the funding reviews that have been in the pipeline for quite some years, including what they call a full reset of business rates, which for us had the potential to be really impactful. So that was why the score for that was updated at that time on that risk. But otherwise, yeah, I think it should be for those members who did attend that session. Hopefully, what's in the risk register here should still sort of strike a chord with some of the conversation that went on that evening. So.
No, thank you very much, Phil. Do any members have any questions? Thank you. Councillor Van Dolken.
Yeah, thanks. It's not really a question, it's more a comment. I've been looking at these for, was it 10, 11 years, I suppose. Why are you laughing? No. And it's the first time I can recall one being in the A category. So, obviously everyone who is involved in this takes it very seriously. So, but I'm pleased to gather that possibly when we come to do it, the next review, that it can be lowered. It's,
No, thank you. Any other questions, members? Okay, so please can I take it that this report has been noted and endorsed? Please show by raising your hands. Thank you very much, members. I can say that the report has now been noted and endorsed, and we'll now proceed to agenda item 10, which is the Treasury Management Strategy for 2026-27. So for members, the report for this item is set out on pages 79 to 92. Please can I invite Mark Jarvis, our Financial Services Manager, to set out this report.
Thank you, Chair, and good evening, members. So the report in front of you is the Treasury Management Strategy for the 26-27 financial year, which at this stage is still draft as we go through the budget setting process. Now, although some of the figures may change slightly as we go through the budget setting process, the overall strategy should not. Now, this strategy is a key component of the Council's financial governance and sets the position criteria for the Council to undertake its Treasury activities. The report was broken down into a number of sections, and section 2 looks at the purpose of the strategy, which in essence is to safeguard the Council's financial resources, to ensure we have sufficient liquidity, and to manage risks effectively while achieving value for money. Section 3 is an economic update. We have included an update from our Treasury advisors, Arlene Close. But in summary, obviously a lot of this is quite topical in the news. We're expecting inflation to drop back down to the Bank of England target, which is 2%. As a consequence, we're also anticipating, well, Arlene Close is anticipating that interest rates will also drop as well. So for the forecast for 2026, we're expecting one rate drop in the first quarter, so from 3.75% down to 3.5%, and then another drop by the end of quarter 2 from 3.5 to 3.25. Section 4 of the report looks at the local context, and I think I'll draw your attention to table 1, which shows a balance sheet analysis. So the key part on here is the capital financing requirement. So just for a reminder for members or for anyone new, the capital financing requirement measures the underlying need to borrow. So it measures how much capital investment has been financed by borrowing rather than grants, reserves or other contributions. So as at the 31st of March 2025, the capital finance requirement stood at 25.57 million. However, by the end of this financial year, we're anticipating this to reduce considerably down to 17.31. The main reason for that is in prior years, the council has invested substantially in regards to the Horizon 120 site, whereby the plan on that site was to incur the expenditure and once we receive the receipts, we'll use those receipts to fund that expenditure. So therefore, now we've sold plots 5, 6, 7, 8, we're now using those contributions to reduce down our capital financing requirement. Throughout the rest of the MTFS period, we're not anticipating to borrow for the capital programme. So therefore, we have got a general decline in our CFR as we repay our internal debt via the minimum revenue provision. Moving on to section 5 of the report that looks into borrowing. As mentioned, we are not anticipating to borrow in the short term or in the medium term. However, the strategy needs to include a strategy for us if we do need to. So therefore, there are items on there that show where we would get funding from if we did need to borrow. Our current borrowing is at 4.6 million, which is a loan we took out in 2022, and that is reducing down by £400,000 a year. Section 6 looks into our forecast balances and our investments. Now, as we are using our reserves, contributions, grants for our capital programme, obviously that's reducing down our reserves, our balances, and therefore our investment balances will go down in accordance with that. So therefore, as you can see in table 3, we are anticipating our average investment balances to reduce, mainly because of funding the capital programme from our own resources. And obviously that will have a knock-on impact in future years in terms of our treasury income. Table 4 on page 85 gives a list of approved investment counterparties. So when we do have excess funds, we will invest that, whether it be the PDLB, which is a subsidiary of or agency of central government, or by other local authorities. But in that section, it gives details of who we would invest with, the time limit, the counterparty limit, and overall sector limit. And finally, before I take any questions on the report, section 9 gives the estimated short-term investment that we're likely to receive next year, and this is based on 3.3% on our short-term investments and a 5% return on our pooled funds, providing 3.1 million worth of investment income for the budget for 26-27. There is a small interest payable, which is 113,000, as well as a 70k refinancing cost when we refinance our Labour debt in 2022. Chair, I'm happy to take any questions.
Thank you ever so much, Mark. Do members wish to speak on this item? Councillor Ramage.
Thanks for that, Mark. Just one question, and you mentioned about the borrowing of 4.6. Is that a set rate, so it doesn't fluctuate? And is that made up of various things as such, or is it just one lump you borrowed?
No, that was one fixed lump. So originally in 2022, we borrowed 6 million at a fixed rate of 2.59%, and that rate is fixed for the life of the loan.
Councillor Prime.
Thank you, Chair. Thank you, Mark, for your report. Just reading through it, your forecasts for your capital financing, we're going up to March 30. We've got local government reform coming in. How are you balancing that into these figures?
Obviously, the impact of LGR, obviously the council will need to basically continue as part of its forecasting in terms of what our forecast is. So, for example, we will have a capital programme that will not stop on the 1st of April 2028. It will still need to continue. So that those costs will still need to be reflected in future years. Once we get to LGR, ours, as well as all of our partners, will need to be amalgamated into one CFR or one set of figures.
Thank you. Thank you, Chair.
No, thank you very much. Any other members wish to speak? Okay, thank you ever so much. So bear with me, because we are asked two things here. So the first one is to consider if the committee wishes to propose any amendments to the strategy or provide any comments or observations which the Cabinet Member for Finance, Resources and Performance can take into account when presenting the final Treasury Management Strategy to full Council. And secondly, approve the draft Treasury Management Strategy for 2026-27, obviously subject to any amendments from Recommendation 2.1, and recommend its approval to full council. So please can I have a proposer to move the recommendations? Councillor Heath, and could I please have a seconder? Thank you, Councillor Ball. So members, the recommendations have been moved and seconded. I will now put this to the vote. All those in favour, please indicate by showing hands. Thank you, members. That is unanimous, and the recommendations have been approved. Before we go to agenda item 11, I did mention earlier that after agenda item 10, I would introduce Mark Twyford. So this is linked to agenda item 5 this evening, the verbal update from KPMG on the progress of the audit of the 2024-25 accounts and reporting. So I'm now happy to hand over to Mark and welcome to the committee this evening. Thank you.
Thank you, Chair. Thank you, members. So, yeah, I'm here to give a verbal update on our audit progress tonight. So, as you've hopefully seen, on 10th of February, we will be given our written update on the audit for the year, which will be our ISA 260 document. I believe that was originally penciled in for tonight, but we've had a slight delay in the timetable. But I think a big part of the purpose of coming here tonight was to emphasise that that is a slight delay, given that we do have a hard deadline of end of February for signing of the accounts. So briefly, in terms of the progress on the actual audit, we are aiming to have our ISA drafted for, I suppose, primarily for sharing with Phil and Mark by next week, so that that can be circulated in advance of the 10th of February meeting. On our actual testing, we've got a very limited number of areas that we are closing out. So there are a very small number of samples on a couple of areas of our income testing. We have also a small amount of work to do over related parties and a few areas of accounts review that we're still undertaking. Apart from that, we are largely closed on our testing, caveating that myself and Emma Larkham, who's the audit partner on the engagement, also have to finalise our review, so there might be the odd question that comes out of that, but again we are reasonably progressed through that review as well. In regards to what we will be reporting, so I think as we've highlighted in earlier meetings, we will be offering a disclaimed opinion on the set of accounts in line with or similar to what we reported last year, but I'm going to run through the areas that will be disclaimed on, because unlike last year, we did carry, actually, I'm not going to undermine myself here and say because we did do a substantial amount of work last year, we have been able to complete on more areas this year. And I'll kind of cover those off in a second just to highlight some of the key areas where we have made progress. But the disclaiming will be in regard to the opening balances. So we did not complete the audit of the prior year accounts, which means that in regard to the opening balances of the accounts, we cannot offer an opinion on those. We will also be disclaiming on the reserves position, and that is because there have been a number of years within which an audit opinion hasn't been offered on the accounts, and there is a build back process that will be required over those reserves. I have been discussing with Mark as well, and this is a separate matter, but there is a build back piece to do over the legacy reserves. So we're talking about last year's set of accounts being disclaimed, and the previous 2 years set of accounts means that reserves position effectively hasn't been audited for 3 years, so there will be a piece to do over that. We have carried out some initial work and looked through the work that will be required to be done on that, and we've shared an initial list of requests with Mark and the team on that. So we have started that piece, but that will run effectively after February once we've signed the current year set of accounts. So there's the opening balances, the reserves. The other area that we will be disclaiming on specifically will be in regards to PPE, so property, plant and equipment, and investment property. And that was an area that we were initially obviously planning to, for the current year, gain an appropriate amount of comfort and audit evidence over. We have not been able to do that for the current year. Emma has circulated, so I should start off with, as per our audit plan, we have engaged our own specialist valuations team to carry out work over this balance. Emma has and myself have both been in discussion with Mark and Phil in regards to why we haven't been able to close out the work here effectively, and without going into perhaps the level of detail that we have done with the finance team on this, but to offer some highlights on that. That is due to a number of reasons that our valuations team have identified to us, and the window, I suppose, of time that we're now left with before signing the accounts. The first one is in regard to, so I'll just run through very briefly a few technical terms, and I will try to keep this as untechnical as I can. So the plant and equipment is effectively split into two areas. You have the property, plant and equipment, which are the fixed assets used by the council in its operations, and you have the investment property, which is property that is held by the council for the purposes of either investment income or accumulating value to bolster the operations of the council. Now, the property, plant and equipment is valued under two methodologies. There's one called a depreciated replacement cost, which is where you have specialised assets, and that methodology will effectively value the assets such as what would it cost to build an equivalent asset today. So, for example, with a specialised office building such as this, what would an equivalent asset cost to build today? That is the methodology used there. You then have an existing use value, which is used for non-specialised assets that have a market value, but are used for the purposes of property, plant and equipment. And then investment property is valued on a market basis. So it is valued against what it would be valued at under market conditions. So the first matter is, in regards to the issues we've encountered, is on the is really in regard to the latter two categories: investment property, which is valued on a market basis, and the PPE that is valued on an existing use value, which is similar to a market value basis. And the first issue we've identified is that within the valuation, our valuation specialists have come back to us and said that the yield data used for that valuation is more limited than they would expect. So there's a specific index that has been used there, which is the Knight Frank index. That is specific to very certain market circumstances where you almost have a pure commercial market, per my understanding. Not all of the properties would fall under that, and they have queried why that more limited range has been used there. The second item they queried was on the DRC, so the depreciated replacement cost, which is our what would it cost to build today type assets, and they've queried one specific asset, which is the Victoria Square retained main block on the Victoria Square development. So there is an element of that building that's not been effectively handed over for commercial use that has been retained. They have queried what the retained usage of those elements is, what it's used for, and whether it should actually indeed be valued under a DRC. They've also identified, in regards to, so again, apologies, very brief introduction, a new standard came in the year called IFRS 16. In short, this means that where you would have historically have had operating leases on which only hit your income statement, which are generally speaking short-term leases, those leases are now to be valued as if they are assets. So you value the term of the lease as an asset effectively. So that's a new standard in the year. Our valuation specialists have again looked at the implementation of that in the valuation and have again queried a number of points on there, specifically over some of the methodology adopted and also the treatment on some of the leases. So specifically, for example, the Whittam Leisure Centre has a 100-year plus year lease on the land. Our evaluation specialists are of the view that that should probably always have been on the balance sheet. I could go in, from an accounting perspective effectively, because 100 plus years is the useful life of that asset effectively. The other area they have queried is just in regard to some of the car parks. This is probably not as a material and area as the other areas I have highlighted, but again, they have queried the methodology around the usage of income purely as a basis of valuation. Technically speaking, there are a number of reasons why they believe this wouldn't necessarily be reflective of a pure market rate. So on those, I suppose, on the basis of the number of areas from their review that they have identified and the fact that that was done on a sampling basis, they are of the opinion that actually, given the timeframes we have, that it would be difficult to close out that specific piece of work. So that is the reason given for why we are, again, disclaiming on that specific piece. Outside of that area, because that is one aspect of the balance sheet, I would like to highlight that actually the other areas of testing where we probably came back this time last year and said, well, we've partially completed income and we've looked at some of expenditure. We are planning to get through testing the income statement. So like I said, there are a couple of samples we're closing out on income. Barring that and pending our review, we have worked through the income statement, so our income, our expenditure, we've worked through collection fund testing. We have worked through the rest of the balance sheet, so our receivables and our payables, our cash balances and our investment balances. The other area that we have tested in the current year, and it does relate into one of our identified significant risks in the accounts, is the journals testing, which is in response to the risk we highlighted in our plan of management override of controls. So again, that was an area we weren't able to start last year. I think thanks to some early discussions with Mark this year, where we ironed out probably some of the issues we had last year in terms of mapping back the journals, we've actually made a very early start on that this year, and that work is substantially complete, again pending final review. So while I do have to highlight the area around PPE and IP as an area that we will specifically disclaim on, the progress we've made this year means that across the rest of the accounts, across the income statement, the balance sheet, so caveating that we are just finalising our procedures and finalising our review, we've made substantial progress on this year, and I think thanks again to Phil and Mark and the rest of the finance team. I think we're able to present a far more complete picture this year than we probably were in the prior year. So I'll leave it at that. I think to never talk too long, and I'll open that up for questions.
Yes, no, I appreciate that, Mark. Thank you. Do any members have any questions? Councillor Van Dolken.
Yeah, thanks, Mark. That's very very good and comprehensive. A couple of things. Do you feel that by the end of next year, then, so 26, 27, would that be?
So we
or 25, 26.
25, 26. So we've just done 24, 25. Yeah.
That you'll have full assurance, let's say, of.
So it's a good question. I think.
I mean, generally speaking.
Generally speaking, so
yes.
The position we move on from this year is finalising that work over the income statement means that next year's opening balances on the income statement would now be considered as audited. So you kind of on your income statement side of thing going into next year, we should be a clean position on the whole of the income statement. The balance sheet, again, it depends. The key outstanding on the balance sheet now would be in regard to the PPE and the IP. Now there is a position we could potentially get to next year where if you could wrap up both years' review in one go, if we get an early start on it, then potentially we could get to a position on that. The difficult part and the bit that's probably harder to comment on without having gone through some of the work would be on the reserves position. That's the more difficult piece, because we effectively have to build up assurance over a number of years of disclaimed reserves. So we have, like I mentioned, started that process with Mark. We'll have to work out what procedures need to be done to build back up to that position. So that's probably that, and I would say the PPE and IP side of things is probably the trickier bit.
Okay, if I could ask a supplementary. You mentioned, I think, yields
Yes.
That did I get it right that that your valuer did not feel that we were achieving the right level of yields, or did I get that wrong?
So not the. So I think there's two things. So you can look at the yield you would get out of an investment property, and are you getting a return on your assets? That's not necessarily what that isn't. In fact, what our value has identified here.
Okay.
What our value is talking about is for the valuation of existing EUV assets, so PPE assets that effectively have a commercialised aspect or non-specialised aspect to them, or for investment property, you look at market yields, and you would look at a broad spectrum of market yields across a local area and across the national market to determine actually, say for example, you've got an office building that you let out, what would that go for on the national market? What kind of value would that hold on a national market? What would it hold on a local market? And you look at those yields across different markets. The commentary our valuer provided back that the breadth of those yields, so the yield that had been used was the Knight Frank Prime Yield Guide. That's almost like a national level thing, and that perhaps what was missing was the breadth of that analysis, so more of a local angle perhaps, more of a consideration of the unique qualities or aspects that the council's assets hold, so in the investment property portfolio particularly. So not necessarily that there is a concern that the council's not getting value for money out of its assets.
Okay, and finally, if I may, an easy one. Is KPMG working with our neighbouring councils, the ones that we might be amalgamated with?
We're certainly working with a good number of them. Yeah, we're certainly
well, it's
working.
Colchester tendering.
Yes, yeah. So
Uplands.
Colchester tendering, I think Malden. I can't remember the full list off the top of my head, but a good number of them
All
for
right.
sure.
No, well, that's
I think
interesting to know.
I don't think there's any talk of Southend, but that's on our radar as well. So we do cover a good chunk across.
And
Essex.
does your team do that, or?
Not me personally. Emma does a lot of them. So Emma, I think what you tend to find is the more senior you get in KPMG, the more of a portfolio you have to cover, and and probably the less time you spend on each of them, because I suppose that's the idea, isn't it? You get more senior and you're a more specific pair of eyes on things. So Emma covers a good chunk of them across Essex. I think she did start covering all of the ones we did, but has managed to, I think, offload a couple of the smaller ones.
No, thank you. Have Councillor Ramage.
Thank you very much. Good evening, Mark. Just a couple of questions, just a clarification. You're looking at the values. Are these values related to just this current period or back years?
Just the current period that we've considered. So effectively, we've taken a view that we were just going to look at the current year end. I think, as I just mentioned to Councillor Van Dolken, actually one thing that we could discuss going forwards next year is how we look at that, given we'll be disclaiming on this year. That would then be a disclaimed opening balance. So we have just been focusing on the 24-25 year end.
Well, what happens to the back years then as such?
So on that is really the question around reserves. So everything that's happened on your income statement, your balance sheet, in all of those disclaimed years will hit through your reserves effectively. Right. So from an income statement and a balance sheet point of view, your accounts only present 2 years. They'll present your prior year. So in this case, 23-24 and 24-25. When we're offering an opinion on a set of accounts, we're actually offering an opinion on both years. So if we don't have comfort over the prior year, we cannot offer a full opinion, because we would say that we would be disclaiming over the opening balances. Outside of that, our key concern in terms of what's happened in other years is just where it has had an impact on the reserves. Because the reserves effectively tell your story of what has happened over the years. Yeah. The rest of your accounts just tells us what's happened in your prior year and your current year. under audit.
Okay. Just one other question. I don't know whether Angie can relate to this as well. As far as you have a valuation on a property, how does that work with the insurance side of things? Is that a sensible question?
So the insurance valuation,
Or is that done separately?
it's a separate set of values, and it's based on a day one value, which is used as the basis for procuring insurance for the whole portfolio of properties. And the insurance we have will typically take day one plus 15% for the purpose of providing the cover.
Okay, thank you. Thank you, Mark.
Okay, thank you, members. If there are no further questions, we'll move on to agenda item 11. But I'd just like to say a huge thank you to Mark for coming over here this evening, and appreciate the verbal update that we've had, and we'll see you at the next meeting that we have coming up shortly.
No problem. Thanks for having me.
No, thank you. So agenda item 11 is the Governance and Audit Committee draft programme of work for this year. This report is set out on pages 93 to 98 of the agenda, and please can I invite Angie to set out this report. Thank you, Angie.
Thank you, Chair. So just one slight amendment on page 96, the meeting 10th of February 2026, the Monitoring Officer's annual report is just for 24-25. Obviously 25-26 won't have concluded by that point. So, Chair, my apologies for that error. So generally this is just to let members know the business that's coming up during the coming year, and for you to consider whether there are any specific areas of training that you need in advance of reports to help you with responding to those reports. There is training currently being planned, and we hope to come back to you soon with some dates for that. That will be in relation to accounts. Otherwise, some of the timing of reports won't necessarily be set in stone. Some of it's assumed, for example, relating to timing of other meetings and how they feed in to this committee's programme of work. And if there are any other matters that this committee wishes to receive reports on, then obviously we can feed those in as well. Thank you, Chair.
No, thank you. So given what Angie has just said, do any members wish to speak on this item? Councillor Heath.
The only thing I was going to say, Mr. Chairman, is on the very last item, on the very last page, it's looking quite good for us to be fully up to date by the time we actually hand the council over to whoever follows us, doesn't it? So, which when we first started a couple of years ago, didn't really look as though that would. I think it's excellent how we, as a council, seem to have got ourselves into a position where we can, I mean, perhaps begrudgingly, but hand over a fully functioning council and a fully functioning set of results, which I think is great.
Yeah. No.
And hopefully I won't be proved wrong.
No, thank you for those comments, Councillor Heath, and I certainly agree with those. So, no, thank you. So, so if there are no questions for Angie, we're asked to agree the Governance and Audit Committee programme of work for 25-26 and to identify the training needs to enable them to effectively discharge their duties. So please can I have a proposer to move the recommendations? Thank you, Councillor Bohr, and I need a seconder as well. Thank you, Councillor Prime. So members, the recommendations have been moved and seconded. I'll now put this to the vote. All those in favour, please indicate by show of hands. Thank you, members. That is unanimous. Thank you. The recommendations have been approved. So we have no urgent business this evening. So this item concludes our business for this for tonight. Please note that the next meeting of the committee is the additional meeting being held on Tuesday, the 10th of February, so not too long until we meet again. And I will therefore close this meeting of the Governance and Audit Committee at 17 minutes past 9. Thank you, members, for your attendance this evening, and for those watching via the YouTube channel, I wish you all a very good night. So thank you ever so much.